So what even is monetary policy? Imagine the economy as a car that's always on the go. The government may be holding the steering wheel, but it's the central bank that controls the car's speed, whether it accelerates or slows down. The central bank can adjust this speed using tools called monetary policy, but let's not get bogged down with the usual textbook definitions. The best way to understand monetary policy is to look at how it affects your day-to-day life. How you actually feel about monetary policy. If you've noticed any of the following recently, there's a chance higher credit card interest rates could be on the cards. Banks are getting pickier about lending money, mortgage payments are going up, and there are fewer job ads. People are holding off on big purchases. Then there's the issue of tight monetary policy. The central bank is putting the brakes on the economy. But if loans are cheap, banks are generous with credit, and housing, car and electronics purchases are on the rise. On top of that, companies are hiring and expanding. Then it's monetary policy that's giving the economy a boost. Monetary policy is basically the invisible hand behind these everyday changes. How central banks influence the economy. Changing interest rates is the most well-known tool. When interest rates go up, borrowing becomes expensive, people spend less, and inflation cools down. When interest rates go down, borrowing becomes cheaper, people spend more, and the economy heats up. Here's an example of what I mean. Picture this: you want to buy a house when rates are low. Your monthly payment is easy to handle. But if rates go up from 5% to 8%, that same house suddenly feels twice as expensive. People put off buying, and the economy slows down. So this is all about how much banks can lend, right? Reserve requirements. Banks have to keep a certain amount of money at the central bank. This is known as the reserve ratio. The central bank can make or break the economy. If it says to keep more reserves, banks will lend less and the economy will slow down. But if it says to keep fewer reserves, banks will lend more and the economy will speed up. Here's how I like to think about it. You want to lend money to a friend, but you've got to keep a bit of cash aside just in case. If that chunk gets bigger, your lending power gets smaller. Banks are no different. So buying and selling bonds is just one of the things the open market operations team does. It sounds technical, but the effect is pretty straightforward. When the central bank buys bonds, it pumps money into the system, which makes banks more relaxed, and this means more loans and a faster economy. When it sells bonds, it takes money out, which makes banks tighten their belts and slow spending. The real-life effect is as follows. When banks suddenly start offering more credit card limit increases, easier loans, or lower borrowing hurdles, it's often because of these operations. Monetary policy is important because it affects the economy, so everything from housing prices to job openings, wages, credit card interest rates, company investments, and exchange rates. It's affected by monetary policy. If inflation is rising, you can expect tightening. If unemployment is on the rise, you can expect to see some cuts. If the currency is unstable, interest rates might change. It's more impactful on our daily lives than we often think. Here are the different types of monetary policy. Tight monetary policy. This is used when inflation is a problem. Interest rates go up, loans get harder to get, spending slows down, the economy cools down, prices stabilize. Every day I feel I'll wait a bit before getting a new phone. Let's wait a bit before getting a mortgage. Not the best time to start a new business. Loose monetary policy. This is used when the economy is weak. Interest rates go down, loans get easier, investments pick up, consumers spend more, and growth returns. Every day I feel rates are low. Now might be a good time to buy a car. Our company might finally hire again. Banks are approving loans more quickly. Here are some of the things that can happen as a result of monetary policy. As we all know, there are no medicines that don't have side effects. Same here. If rates stay too low, inflation will go through the roof. If rates stay too high, unemployment will shoot up. If credit is too high, housing bubbles can form. If credit is tightened too much, businesses can struggle. Central banks are always trying to keep things balanced. So what even is monetary policy? Monetary policy is basically the central bank's toolkit for managing the economy. It's in charge of inflation, affects growth, impacts unemployment, controls credit, and manages the money flow in the system. Whenever you feel the economy is speeding up or slowing down, monetary policy is working behind the scenes.